So we're going to be going into low-income housing tax credits. And low-income housing tax credits are a very specialized program and field. It's a very powerful program, but it's also a very complicated program. So we're going to talk about some of those complications and how the program could potentially impact your projects. So I'm going to start actually with what may seem like a odd subject, but types of income. There are three types of income that the federal government recognizes, or the Internal Revenue Code, I should say, recognizes. And this is important because low-income housing tax credits are a passive income tax credit. And so we have to know the difference between active income, which most of us have, versus passive income, which you probably only have if you own rental real estate. So active income is your income from wages and salaries. It is, your paycheck. It is basically income that you receive in activities that you materially participate in. So, that typically means that you spend at least 1,040 hours in that activity. So, with my job, I spend, at least 1,040 hours working. At least that's what I tell my boss. No, I actually do. And so that my wages are considered active income to me. Now, there's also portfolio income, which really doesn't apply to this this discussion, but portfolio income is, from your stocks and bonds, from your savings account, things like that. And then there's this passive income. And passive income is income that you receive from a source that you do not actively participate in a regular, continuous, and substantial manner. And with rental property, in essence, the property itself is generating the income. Now, you may manage the property, and if you actively manage the property, there are some provisions that we'll talk about that may allow you to take some passive losses. But basically, it is the rental property itself which is generating the income, and that's why it's called passive income. And as a rule, passive tax credits and passive deductions can only be used against passive sources of income. So these tax credits, the low-income housing tax credit program, basically can only be used against a developer's or building owner's passive income. And oftentimes the issue becomes that, especially early on in a career, you may not have enough passive sources of income to use all these tax credits. And so we're going to talk a little bit about syndication, which is how you can help bring a partner on that can utilize those tax credits that your project generates. So there are a couple exceptions to the rule that I just stated, which is that typically passive losses or passive tax credits must go against passive income. And so there's what I call the small investor rule. So the small investor rule is that basically you can use up to $25,000 of passive income losses to offset non-passive income. But you have to meet some criteria. So first of all, you're supposed to use those passive losses against your passive income first. So, let's say that you have $100,000, or no, let's say that you have $10,000 of passive income, and you have a $24,000 per year tax credit. you have to use the first 10,000 of that tax credit against that passive income. And then the remaining $14,000 of the passive income may be eligible to be used against your active income if you meet the next two bullets. One is that you have adjusted gross income under $100,000. Now, unfortunately, that $100,000 has not been adjusted since 1986. It was set in the 1986 Tax Reform Act, and Congress did not index it to inflation. So back in 86, $100,000 was the wage of a doctor or a lawyer. You know, $100,000 now is, you know, nurses, master's degree teachers, you know, those many more middle income individuals. And you have to be an active participant in the investment. So you are actually managing the property. You're not using a management company to manage the property. So you are materially participating in the management of that property. So that $100,000 starts to go down, and it basically phases out completely at about 150,000. So if you are up to 150,000, you may be able to use this small investor provision, but above that, unfortunately, you can't use this at all. Now, many of you, though, may be able to use this second exception, which is the real estate professional rule. And the real estate professional rule is that if you actively work in one of basically 5 areas and for yourself, not as a wage and not as a W-2 employee for another firm, then you may be able to be classified as a real estate professional. And for real estate professionals, since the majority of your activity is in the realm of real estate, which generates passive income, then the IRS will treat your active income similar to your passive income. So they'll basically say that there's no difference for you between active and passive income. So, you know, that means that you basically have to spend at least 1,040 hours in leasing, brokering, constructing, developing, and managing property. I actually got all 5. That's a, you know, miracle, because I usually forget one of them somehow. So if you think that you qualify as a real estate professional, I strongly suggest that you talk with your tax accountant regarding getting that designation to see if you qualify. And that also just reminds me that nothing that I say during this deep dive should be considered either legal or accounting advice. If you need either legal or accounting advice, you need to get such at your own expense. Thank you very much. So there are a couple of exceptions to those rules. So for a lot of developers, especially with low-income housing tax credits, you're going to be generating a lot of tax credits. And you'll probably be generating more tax credits than you have in terms of passive income. And so you're going to need to find a partner that can utilize those credits. And oftentimes what we do is we partner with a corporation, because for corporations, there is no difference between active and passive income. For a corporation, income is income. And so that's why in a lot of these low-income housing tax credit deals, it is a financial institution, usually a bank, that will join in on these deals. They can take the tax credit and they can invest equity into the project for those tax credits that they're going to get over time. So
Corey, we have a quick question. Does a
Sure.
general contractor qualify as a real estate professional?
Yes, construction is one of the five activities um, for that. There's actually an IRS publication specific to real estate professionals. So I encourage you, even before you incur the expense of talking with a tax accountant, is to pull down that free publication from the IRS website. If you search on the IRS website, real estate professional, it'll come up. It's like a mere 50 pages, So like everything you possibly want to know about getting designated as a real estate professional is in that. And the other nice thing is that they also go through some really useful scenarios. So you're a potential real estate professional, but your spouse gets W-2 income, right? So your spouse is getting active income, you're presumably getting passive income. How do you deal with that split? So there's actually some scenarios in that publication that'll explain to you the rules around that. So it's a really um, lengthy, detailed publication. Um, Great if you have insomnia, but um, I'm one of those masochists that actually reads that kind of stuff. Um, all right. So who can use passive losses, right? As I mentioned, corporations are the easiest to because for them there's no difference between active and passive income. So, other folks that can use it would be an investor with substantial passive income. Those are typically people with large portfolios of rental properties, right? They're generating a lot of passive income, and therefore they have that capacity to utilize more passive losses. And then those active investors with adjusted gross incomes under $100,000. And one of the things that I hope Congress will eventually address is this fact that they've never indexed this to inflation. So this is starting to limit more and more people from being able to use this, this small investor exception. So let's talk about tax credits, right? So a tax credit, and this is we're talking about the low income housing tax credit here. A tax credit is a dollar for dollar reduction in your tax liability. So there are four types, and I believe that there's been a deep dive, at least there's a recording of a deep dive for the historic rehabilitation tax credit. We're talking today about the low income housing tax credits. There is the new market tax credit. And so new market tax credits can impact residential projects that also have a substantial commercial component to it. So new markets cannot be for a residential only project. And then the investment renewable energy tax credit. And so many of these are possible to combine together. So you can combine historic rehab tax credits with low income housing tax credits. You can combine low income housing tax credits with renewable energy tax credits. The one program that, or the one exception to using these combined is low income housing tax credits and new market tax credits. Those two programs cannot be used on the same legal description. So what we've done on projects is we've created a commercial condo for part of the building, and then maybe a residential condo that's the LIHTC portion. So we can use both programs on the same project, just not on the same legal description. So keep that in mind. So the low income housing tax credit. It's actually a credit that you get in the same amount each year for 10 years. And the project has to qualify based on 3 criteria. First is you have to meet an income and occupancy test. So this is not a program that you can use for 1 unit in a complex that has 100 units, right? There are some requirements, some thresholds that you have to meet. There's going to be rent restrictions. For any unit that you're getting low-income housing tax credits on, you're going to have rent restrictions on those units. And then it is actually state housing finance authorities that allocate the credits, with 2 exceptions. There are actually 2 city housing finance authorities. Both New York City and Chicago get allocation directly. Otherwise, this goes to the states. So NYFA, the Nebraska Investment Finance Authority, is your state allocating agency. And, you know, each allocating agency can set up their own rules above and beyond the federal threshold rules. So the federal government sets the base level of rules, and then states can add rules on top of those. And those are detailed in what's called a qualified allocation plan. So it's actually your state, it's actually going to be NYFA that allocates your low-income housing tax credits. So let's go over the income and occupancy test. So at a minimum, you have to meet either the 2050 rule or the 4060 rule. So the 2050 rule is that 20% of the units must be occupied with tenants with incomes at or below 50% of the area median income, AMI. And the area median income is based on a county income level. So it's not the city of Nebraska, it is the county AMI. And so, and that can be, there can be significant differences, particularly if your central city tends to have lower incomes than, say, your surrounding suburbs. And that's definitely the case in my hometown of Detroit, where the county area median income for a family of 4 is about $68,000, whereas the city of Detroit's area median income is actually less than half of that. It's around $32,000. So just because something is affordable from the countywide standpoint sometimes means that for the city of Detroit, it's still not really affordable. And so we have to keep that in mind. Just because you can charge a rent at, say, 50% of the area median income doesn't necessarily mean that that's the market rent for your neighborhood. So we have to meet either 20% of the units at 50% of AMI or below, or we can have 40% of the units as long as those units are occupied by tenants with incomes at or below 60% of the area median income. So if you want slightly higher rents, then you have to have more units, basically. So you have to meet either one of these rules, 20% of the units at 50% AMI or 40% of the units at 60% of the AMI. And so those are the minimums. Now, what I often find is that, especially in today's market where construction prices are very high right now, oftentimes folks really need the subsidy on all the units, and therefore projects will actually be 100% rent restricted. So there is also the possibility to have a mixed income project where you have tenants that are not rent restricted along with tenants that are rent restricted. And you can also, within those rent restricted rent units, you can actually do income averaging. And what income averaging allows is for you to have units that are above that 50 or 60% level, as long as there's an offsetting unit that is below that, so that the average equals the income qualifier. So let me give you an example. My project's doing the 40-60 rule. So on average, all my LIHTC units must be occupied by families at the 60% AMI or below level. But one of the things I could do is I could have a unit at 80% AMI as long as I have a corresponding unit at 40% AMI. Because when I average those AMIs, they average to the 60% AMI level. And so that allows you to balance some higher income units with some deeper affordable units in the same project and still meet that criteria. So not every state has adopted income averaging, and not every investor yet is fully on board with income averaging. So it's something that is out there. If it's something that is appropriate for your project, push for it. I think, that's really important, but understand that there may be some pushback. Um, it's actually been around for about 5 years. The first 3 years, the industry didn't adopt it at all because there weren't good rules yet. The IRS did finally publish some rules that have made investors more willing to consider these. Oops. All right.
Do we have any questions thus far? Everybody's tracking. We'll probably rewatch this in the future. But please feel free to add questions or raise your hand or whatnot in order to engage.
Corey, you made the comment that you could have up to 100% of your units as LIHTC. That would mean that basically all of your units are below that 60%, correct?
That's right. Yep.
But did you say that there was a max size on the number of units you could have?
No, it really depends on, so each state gets a maximum amount of credits each year. So there's a natural limit there, but that's literally in the thousands of units. So no, I've seen projects where, there's 200 or 300 units that are going to be rent restricted. So you can have a large number of units. That's typically with the less competitive 4% credit than the more competitive 9% credit. So, typically projects for the 9% more competitive credit are, in my experience, under 60 units, because it's just your state housing finance authority wants to spread the program out among, well, and first of all, the entire state, right? They're getting a statewide allocation, and so they're not going to put all their allocation into one city or one community. And so typically they'll set up the scoring in such a way that you'll see what size projects they want to see. But it's typically, the vast majority of projects that I see are somewhere between 35 and 60 units for the 9% program.
Okay, thank you.
Yep. So the second criteria for LIHTC are the rent restrictions. So all the units receiving low-income housing tax credits have rent restrictions. And those rent restrictions are based on the number of bedrooms and an imputed household size. And that imputed household size is basically the number of bedrooms times 1.5 persons per bedroom. And so basically, a quick example of this is that if you have a 2-bedroom unit, your imputed household size is 3 people, right? Because it's 2 bedrooms times 1.5. Now, if you have a studio, then that is considered for a 1-person household. So what this means is that, in essence, if a couple moves into a 1-bedroom unit, they're going to end up paying slightly less than the maximum that they could, because that 1-bedroom unit is actually priced for a household of 1.5 people. Versus if that couple moves into a 2-bedroom unit, they're going to be slightly house burdened because that 2-bedroom is really being priced for a household of 3. So it's not perfect, but it provides surety. And this is very important since I'm talking to a group full of developers. You need surety in terms of your rents. And wouldn't it be awful if you had to change your rent every time the household size changed? So, the couple gets divorced, and so now instead of 2 people, you have a household of 1. Do you have to change your rent to accommodate that? No, you don't, because the rents under this program are set based on the household size, or based on the number of bedrooms, not on the household size. I think it'd be utter chaos if the program was set based on household size. So this makes sure that you know how much rent you can expect. Now, it does create a problem. All of you developers are constantly fighting over the upper half of people, so you don't have to put in as many toilets. All right, Tamara got it. Come on, anyone else? Boom, boom. It's my favorite LIHTC joke. In fact, I think it's the only LIHTC joke that exists because it's, not that funny of a program. But all right, so let's move on. So once you figure out that household size, then the rent cannot exceed 30% of that income qualifier. So if you're targeting a 50% AMI unit, then it's 30% of 50% of AMI. If it's a 60% AMI, then it's 30% of that. And maximum rent includes all utilities except telephone. So you have to keep that in mind as well. If you have tenant paid utilities, you have to offset their rent by those utilities. So let's go through an example. So we have a 2-bedroom unit, and so the imputed household size is 3 people, right? 2 times 1.5 is a 3-person household. So if the median income for the 3-person household is $51,000, and that's just an example, this is not your county AMI, and we're using the 40-60 rule in this case, then 60% of that median income is $30,690. But we don't think of rent in a yearly standpoint. We think of rent in a monthly standpoint. So let's think about their income from a monthly standpoint. If we divide that $30,690 by 12, we get $2,557 per month. And under federal guidelines, they should not pay more than 30% of their income in housing. And so 30% of that $2,557 is $767 per month that can be allocated towards housing. So that housing includes the utilities for that housing. So the tenants in this case have to pay, maybe it's, they have to pay heat and gas for hot water. All right, those are the two utilities that they have to pay. So based on a utility allowance of, in this case, $75 per month, the maximum rent that we can charge them is the $767 minus that utility allowance. So the maximum contract rent is $692 per month. And one of the resources that that Angel shared was the Grow America spreadsheet. And in the pro forma section of that, we help guide you in this so that you can put the unit type, you can put how many of that unit type you have. And then this maximum rent is that maximum contract rent, right? It is the $767 per month. And then there's the utility allowance. So this would be the $75 per month. And then the system will automatically calculate your monthly rent for you. Now, if you have a market rate unit, you're not going to have a utility allowance. So I've seen lots of projects where maybe my one bedroom, I've got two one bedrooms that are LIHTC units, and I've got 3 1-bedrooms that are market rate units. So I might have my max rent for my LIHTC unit be $767, but then I have to subtract the utility allowance. My maximum rent for my market rate unit is also $767, but I don't have to remove a utility allowance for that one because I'm not getting any LIHTC for that unit. So if you have a market unit, you don't have to worry about this column.
Or if you don't have a market unit and you as the owner already pay all the utilities, correct? If
That's
you're
right.
providing,
That's right.
okay.
If you pay all the utilities, then you don't have to worry about utility allowance. And one of the things that I've always been really interested in, I've not seen a good case study yet, but in theory, if you made a highly efficient building, you could potentially end up with higher income by the owner paying all the utilities, because you're actually paying less in actuality than you would lose in terms of the utility allowance. So that'd be an interesting case study that I'd love to find and do an analysis. So if we have a 1-bedroom unit, then we have to take the average between a 1-person household and a 2-person household, and we're going to average those out in order to figure out our rent. So in this case, a 1-bedroom unit is an imputed household size of 1.5 persons. So if the median income for a 1-person household is $39,750 and the 2-person is $45,450, then the midpoint between those two is $42,600. So that is our imputed area median income. And so then we take 60% of that is $2,130 per month. And then it's the same 30%. So 30% of 2,130 is $639 per month. And then again, we may have to remove our utility allowance. So if you are getting any sort of rental assistance or payments for supportive services, maximum rents do not include any of those. So one of the things that I've seen is where a person brings with them a Section 8 voucher. And so say the Section 8 rent is, the voucher rent is $800, but the 50% AMI rent for the unit that they're looking at is $500. You can charge the $800 in rent, and as long as and because the Section 8 voucher makes sure that they never pay more than 30% of their income, you are meeting the rent restriction by definition. And then maximum rents do not include any tenant payments for services. So, and this is kind of rare, but sometimes with like assisted living projects where it is people are paying for the rent, but then they can also buy into, say, a meal plan, or they can buy into cleaning. As long as those services are voluntary, then you don't have to remove those from the rent. But if those are included in the rent, then you have to exclude that from your rent calculation. So if it's a mandatory service, then you have to exclude it from your rent. So like I said, that's a fairly rare situation. So this doesn't apply to the Omaha area, but if any of you decide to do a project in a non-metropolitan area, sometimes those non-metropolitan areas have very, very low area median incomes. And so in that case, you get to choose the higher of the of that actual county's area median income or the national non-metropolitan area median income. So it gives you a little bit higher rent level. So
you can choose, you use the higher one, either
the
the
higher
actual
one.
county income, or
Yeah.
if the national non-metropolitan income is higher, you use the national one, whichever's
Yeah,
higher of those two.
I looked at a project in a rural county in southern Tennessee where the area median income for a family of 4 was $24,000. And so 60% of $24,000 is, if I remember correctly, is like $18,000. And so it the rents would be so low that you couldn't even cover the operating expenses on the unit. And so in that case, we're able to use the higher national non-metropolitan area AMI, which I think, and I haven't checked it in many, many years, but last time I checked it, which was about 7 or 8 years ago, I believe it was around $36,000 per year. So, so that's quite a difference between the 24 and the 36. And so what it basically meant was that in this county, nearly everyone would qualify for the LIHTC units because, the vast majority of people were at or below that national non-metropolitan AMI. So the final criteria is state approval. So this year, each state, so NIFA received $2.75 in LIHTC for every resident. And it's actually NIFA, it's actually your state agency that allocates the credits. They pick what projects they're going to fund. And there are a few criteria that the federal government requires. First of all, they have to set aside 10% for nonprofit sponsored projects. Could be owned by or sponsored by a nonprofit. And then their qualified allocation plan also has to consider energy efficiency, typically things like enterprises, green buildings, or LEED certification. Each state designates what sort of energy efficiency standard they want or that they'll allow. And then also the preservation of affordable housing. This program dates back to 86. And so in that time, there's a 15-year compliance period with this program. And so in that time, there's been lots of projects that have gone through this program that have where the compliance has expired. And so rather than lose those projects, the federal government is trying to encourage projects to come back in for re-syndication and get those rent restrictions reapplied. And really, that qualified allocation plan is your key document. So if you're interested in low-income housing tax credits, the other long document that you need to read, besides the real estate professional document that the IRS publishes, is the qualified allocation plan. So the qualified allocation plan is basically NYFA's description of how they're going to allocate this precious resource against over the entire state. So how they're going to score things, how they're going to, pick which projects get allocation and which don't. So you really need to understand that qualified allocation plan. And every state is slightly different, and so what I'd like to say is that, it's all the LIHTC program, but there's actually 55 versions of it, because all 50 states have a plan. New York City and Chicago also have a plan, and then the 3 U.S. territories also get LIHTC. And so each one of those has a different way of allocating these credits.
And Corey, I did put that link in the chat.
Great.
NYFA does have that specific PDFs in there. And our last guest speaker at our DA social, Jake Hoppy, actually talked about the low income tax credits and how they review scoring and kind of see all of the scoring for everyone that applied in order to see where they did well and not, in order for them to be more competitive. So it was a pretty good really conversation. Mm-hmm.
Yes. Study the competition. Study what scored well the last session, and that will help guide you to see if your project, has a chance. And also keep in mind that the scoring criteria tends to shift over time. Typically not radically, but it does tend to shift over time. So, for example, for a while here in Michigan, the walk score. So our state housing finance authority, MISHDA, had you click on a link and put in the address of your site, and it would generate a walk score. And what was happening was that projects in Detroit, there were very few locations in Detroit that were getting decent walk scores compared to a lot of smaller cities in the state. And so in the end, for a couple years, a lot of that 9%, that precious 9%, were going to those smaller cities because of that one criteria. These things are very, very competitive. So understanding kind of where you can get each and every point is really, really important. So there are 2 types of LIHTC credits. There's a construction credit and there's a building acquisition credit. So we're going to talk about the construction credit first, and then we'll talk about the building acquisition credit. And then the construction credit actually has 2 credit levels within it. So a little complication on top of complication. So let's talk about the construction credit. So as with all LIHTC, it is a 10-year credit. You get the same credit amount each year for 10 years. And it's available for new construction, or if you're rehabbing a building, for what's called substantial rehabilitation. And substantial rehabilitation under this section of the IRS code is the greater of either $6,000 per unit or 20% of the adjusted building basis. And so if you just recently acquired a building, the building basis is basically your acquisition price. If you've owned the building for a while, you really need to talk with your accountant as to what your building basis is going to be, because the building basis includes your acquisition price plus any improvements that you've made over time, minus any tax depreciation that you've taken, minus any amortized fees that you've taken, and minus any rehab tax credits that you may have taken in the past. So it gets complicated really fast, but it's basically, if you recently acquired the building, say I acquired the building for $1 million recently, then I need to spend at least $200,000 in rehab in order to qualify for the construction credit. Now, most projects want to go for the 9% credit because it's a lot more equity, and deals are much easier to finance under it. But the 9% credit are extremely competitive. You can get the 9% credit basically as long as you are not using tax-exempt financing. If you are using tax-exempt financing, then you're stuck with a 4% credit. 4% credits have a different allocation schedule and are typically not competitive in most states. And I haven't checked in Nebraska in a while, but I don't think that the 4% credits are currently competitive in Nebraska. And so for the most part, most projects are seeking 9% credits. And we'll go through some examples of why that is, why most projects end up having to go for the very competitive 9% credit. Now, you can also get a basis boost for some projects. And so if your area is a difficult development area, and I'm not aware of any difficult development areas in the Omaha area, but those are areas that are designated high cost areas. Think about, say, areas along the San Andreas Fault in California, right? Those are areas where you have to do extra building because of the seismic issues. Western Kentucky, where they have groundwater issues, the groundwater takes out the limestone and creates these chasms in the, beneath the surface. That's what caused the Corvette Museum to sink into one of those chasms, was because of the geology of the area. So those are designated high cost areas, or a DDA. So Omaha may not have any DDAs, but more than likely you have qualified census tracts. and probably there are many qualified census tracts in both the northeast areas of the city and the southeast areas of the city. So qualified census tracts are census tracts with median income below 60% of the area median income, or where 20% of the households are below the poverty level. And so that is basically by census tract. And there are some convenient ways. NIFA, I'm sure, has a link to how you can look up to see if you're in a qualified census tract. Now, in addition to these two areas, if you're in a DDA or you're in QCT, NIFA can also just set up a situation that would grant you additional credits if you meet a certain criteria. So, for example, and I don't know that this is happening at all, but I know that Omaha is exploring a streetcar. So one of the things that NIFA could do, not saying that they are, but could do, would be that they could say, we're going to grant any LIHTC program within a quarter mile of the streetcar a basis boost, regardless of if it's in a QCT or not. And so that's something that, for example, Chicago did, where if you were not already in a QCT, but you were within a quarter mile of the L, you could get a basis boost. So it's a way that a state can kind of guide this a little bit more. So sometimes states will use it for high opportunity areas, such as jobs or transit corridors, and so forth. So what qualifies for your basis? Well, it's just about everything that is consumed during construction. So everything that is long-term depreciable. So that includes your construction costs, your on-site improvements, your permits related to your construction, your construction interest, the construction loan appraisal, inspections, your property taxes during construction, your insurance during construction, of course, your architecture and engineering fees, because you can't really be doing construction without some sort of plan, performance bonds. You get the LIHTC credit on furnishings. Remember that this is a population that more than likely is not coming to the unit with their own refrigerator, stove, etc. And therefore, most projects supply those items. And so you get the tax credit on those furnishings. You get the tax credit on your developer fee, any development consulting, your contingency if you actually spend it. So all those things are items that are consumed during construction. What you don't get the construction credit on are things that benefit the project over the long term. So those things that are amortizable. Your permanent financing expenses, your reserves, your marketing, tax credit application fees. You don't get any construction credit on the acquisition. There's a separate program for acquisition, right? There's the acquisition credit. No offsite improvements and no non-residential spaces, right? This is the low-income housing tax credit. So if it's a mixed-use building, you're not going to get the LIHTC on that restaurant on the first floor. Now, if you have space that is open to the residents continuously and without charge, so for example, if you have a computer room, if you have a workout room, if you have office space that's available to the residents, that space can be included because it's considered to be an amenity of the residential. But anything that you're charging someone else rent for, such as a restaurant, a store, anything like that, you don't get the LIHTC credit on. You also don't get the LIHTC for those non-restricted units, those market rate residential. Remember, this is the low income housing tax credit. And again, you don't get the 9% credit on any expense paid for with taxes and bonds. There's the 4% credit for that. So let me just quickly go over to our pro forma and just show you, and many of you are familiar with this pro forma, but we have a development budget here where you place your project's items, and it will automatically
Corey,
pull
can you make that
over.
bigger?
Sure. So it will automatically pull the expense over to the applicable program. So in this class, we're talking about LIHTC. So my $100,000 of site improvements count for both the 4% construction credit or the 9% construction credit. Whereas off-site improvements, if I have off-site improvements, you'll notice that that does not pull over under the LIHTC program. So this is a handy way to help determine your basis. Now again, you're gonna need an accountant to help you determine exactly how much is gonna account. But this at least, when you're in a go no go situation, when you're in that preliminary trying to see if this works or not, this will give you a good sense of how much your basis is. If you happen to get a grant, one of the things that you have to be careful of is that grants, you do not get LIHTC on any money that has been granted directly into the project. And so you have to either allocate that grant to something that does not get LIHTC. So for example, if I have land acquisition of $500,000 and I have a $200,000 grant, I can allocate that grant to the land acquisition, and land does not get the LIHTC credit. But let's say I had a $700,000 grant. Well, then I can do $500,000 towards this land acquisition, but $200,000 may become problematic. I may have to exclude it from my LIHTC basis. So typically with grants, we structure it as a loan into the project in order to avoid this problem, this situation. So let's take a look at an example. And this is one that I think some of you may be considering right now, because I know that a lot of the sites in both North and South Omaha are ripe for mixed use development, maybe first floor commercial, upper floor residential. So here's a situation where it's a mixed use project in a qualified census tract. So we get a boost. And so we have $500,000 of land acquisition. We have $4 million of residential construction. We have $1 million of commercial construction. And so in this case, we are we need to exclude the commercial construction from our project. And also the land, remember, land does not get the LIHTC credit. So our basis here of these three items, it's the residential construction that qualifies. So down here we have our $4 million of residential construction. we get to multiply that by 1.3 because we're in a QCT, we are in a basis boost. And so our credit basis is then 5.2 million. And we're going to go for the 9% credit. And so we get $468,000 of annual credits. And we get those credits for 10 years. And so our total low-income housing tax credits are 4,680,000. So do you notice that we actually get more credits? We get more low-income housing tax credits that we're actually even spending on the residential. So in this case, if we found a corporate investor that's willing to invest 85 cents for every dollar of credits, we can generate $3,978,000 of equity for our $4 million cost of the residential construction. And so in this case, yep.
Corey, you said that the land, if we had a grant, let's say that the city had a grant program like the Omaha Land Bank, and they said, we're going to give parcels that is a 5-year forgivable note if you build on it.
Sure.
And it's $500,000. You're saying that land basically zeroes out. It doesn't count towards LIHTC. It doesn't count towards anything as long as all that grant is used just on land, correct?
That's right. Yep. Yep. So anytime you get a grant, you want to try to allocate it to something that is not on this list.
Not on LIHTC.
Right. Not on
not
these
available.
lists. So
okay.
Put it towards offsite. Put it towards your permanent loan fees. Put it towards title and recording. Put it towards your tax credit application, your marketing expense. Any of these things that are shaded out, that's where you want to allocate that grant.
Okay.
So here we have maybe a conventional loan that's covering the commercial. We've got some, don't worry about what CDBG is. Let's just say that this is some city money in the deal. And so we've got $522,000 of some city money, and that's covering the land and the shortfall between the equity and the residential construction. Right. Looks simple, and it looks, as you can see, very powerful, right? This 9% credit, because you get it over 10 years, brings a ton of equity to the deal. But unfortunately, you guys aren't the only ones in on this secret, right? Lots of other developers know about this. And so there's lots of competition for this program. Depending on the state and the year, I've seen where states receive 10 times as much demand as there is supply in terms of the LIHTC credits. So very, very competitive. And that's where understanding that qualified allocation plan becomes key, because that qualified allocation plan is setting up the criteria of what's a competitive project and what's not a competitive project. So let's look at this same project, except with the less competitive 4% credit. And so with the less competitive 4% credit, we're using tax-exempt financing. So the uses are still the same: $500,000 land, $4 million in residential construction, $1 million in commercial construction. So we're going to take that $4 million of residential construction. We're still in a qualified census tract, so we still get the 1.3 boost. So our credit basis is 5.2 million, but we're stuck at the lower 4% credit rate. And so we multiply that 5.2 million by 4%, which generates only $208,000 of annual LIHTC, which we get for 10 years, which means $2,080,000 of total LIHTC. And so if we are able to find an investor willing to invest 85 cents for every dollar of credit, we're able to generate $1,768,000. So it's less than half of what's the residential is generating. But the problem here is that you still have the same rent restrictions. And so there's a little note here in red at the bottom. You know, often the restricted rents just can't support this much debt. You notice in the other project, we actually didn't have any hard debt necessarily on the residential, right? All the conventional loan was really related to the commercial, but this city money was probably set up as a loan, but maybe with some better terms to it. With the 4% tax-exempt financing situation, we're trying to take on $2.7 million of loan. And so we typically need a large amount of city money in this case. So 4% are great if you can find the source of additional revenue. And more than likely, you're going to need more than this million of CDBG or home, or it could be direct city dollars. You're probably actually going to need somewhere on the order of $2 to $3 million, because you just can't take on $2.7 million of debt under these scenarios. So both programs are out there, but there are good reasons why everyone goes for the 9% deal. So the other credit yep, go ahead.
Is there ever a case where the 4% is a better fit?
Yes, there is. So the one scenario that I see the 4% used most often in the Midwest is for moderate rehabilitation of units, of existing units. So let's say that I find a 100-unit apartment building that needs some refresh, and I'm going to be doing, say, $50,000 per unit. It needs about $50,000 per unit, and it's already in a low income. It's already in a naturally occurring affordable area. So sometimes you'll hear the word NOAA. It's a naturally occurring affordable housing. So if the rents are already, if the market rents are already at a 60% AMI rent or below, then one of the things that I can do is I could go for the 4% non-competitive credit, and depending on the amount of renovation that I have to do, the numbers sometimes do work out. So you can generate just enough equity to get you past that hurdle. So yeah, so 4%, it's not that they're never used, but I bet if you look at NYFA's 4% deals, what you're gonna see is mainly moderate rehab projects where they're spending, $40,000 to $60,000 per unit is the range that I typically see where it works out. All right.
Can
so
you apply?
What's that?
Can you apply for both the 4 and the 9% when you submit?
It depends on the state. So some states, they actually, you submit one application and your state housing finance authority decides if you're getting the 4% or the 9%. You don't even get to choose which you're applying for, right? So like I said, every state is different. And so you'll have to check your QAP to see if they do it that way. Usually for states where the 4% is non-competitive, the state usually has a rolling round for that, or an open application for that. Whereas for the 9%, there's usually set application dates. And usually it's not more than 2 rounds a year for that. So, so I mentioned that there's also this acquisition credit. And this applies only in the case of a substantial rehabilitation. So it's also an annual credit for 10 years. It's always a 4% credit. There's no such thing as a 9% acquisition credit. The previous owner must have owned the building for 10 years, and you don't get the boost on the acquisition. So this is also where that scenario that I just mentioned, I'm buying a 100-unit complex. The previous owner has owned that complex for at least 10 years. I may be able to get a 4% credit on my acquisition and then also get the 4% credit on the moderate rehabilitation that I'm needing to do on the building. So I often see 4% credits on the construction side teamed up with 4% credits on the acquisition side. But the acquisition credit is not restricted to the 4% construction credit. The 4% acquisition credit can be combined with either the 9% or the 4% construction credit. They're really kind of, in many senses, two separate programs. So here's a project that involves, it's a rehab, and we've got significant acquisition costs. So we have a $2 million acquisition tab. Half of that $2 million is related to the building. And remember, you only get the acquisition on the building value, not the land value. So, and we're doing a $4 million rehab on that. So the $4 million times the 9% credit rate is $360,000. We have a $1 million building value. We get the 4% credit on that building value. So we get $40,000 on that. When we combine those two, we get $400,000 of acquisition, and we get that for 10 years. I'm sorry, we get 400,000 of allocation. We get that for 10 years. So we have total LIHTC of $4 million. And if an investor is willing to invest at 80 cents on the dollar, we generate $3.2 million of equity. So again, you'll see that this 9% program can really cover quite a bit of your rehabilitation expenses. So right now, both credits are fixed. There are some older projects where the credits were not fixed, but most of those have wrapped up by this point. So, and like I said, who can use LIHTC? It's primarily corporations, because corporations, LIHTC is a passive income credit, and corporations don't see a difference between their active and passive income. So corporations can use as much LIHTC as they have tax liability. But in particular, banks are interested in LIHTC because banks have to deal with what's called the Community Reinvestment Act. And the Community Reinvestment Act requires financial institutions to make investments where they take deposits. In fact, the Community Reinvestment Act is undergoing some rule changes right now. So I strongly encourage you to check out some of those rule changes and possibly submit public comments on that, because the Community Reinvestment Act has more impact on community development than the LIHTC program, than Community Development Block Grant, than home, than anything else, because it impacts private sector behavior. And so it's extremely important for the benefit of low and moderate income areas. And so so banks particularly like these investments because they get gold stars under the CRA program. And there is one interesting thing about LIHTC. So LIHTCs can offset taxes on passive income and taxes on up to $25,000 of non-passive income, regardless of the investor's income. So that small investor rule of up to $100,000 does not apply to LIHTC. So basically, I think Congress felt that because LIHTC has a social good associated with it, that the rules are somewhat loosened compared to, say, the rehab tax credit program. So while LIHTCs are a 10-year credit, your rent restrictions last 15 years. And not only do they last 15 years, but most states extend that in another 15 years. So these will be rent and income restricted for, in most cases, at least 30 years. Here in Michigan, you get extra points if you extend 30 years rather than 15 years. So in essence, these units are going to be rent restricted for 45 years. And they do that. It's optional, right? But you get extra points if you opt in for it. And these things are so competitive that basically you have to opt in. If you ever want a chance at getting the credits, you really have to opt in. Every single point counts with this program, in every single state. This program is, I don't know of an area where 9% LIHTC are not extremely competitive. So, and unlike the rehab tax credit program, LIHTC does not reduce your depreciable basis in the property, which is really nice. You can combine rehab tax credits and low-income housing tax credits. However, you have to keep in mind that the rehab tax credit reduces the basis for the low-income housing tax credits. So here we have a $4 million rehabilitation. I don't know if you've noticed throughout my lecture notes, everything's been $4 million. You know, it's just, your project may not cost $4 million. It may cost something else. But it's just an easy number for me to keep in mind. So, so this $4 million rehabilitation times the 20% credit rate would generate me $800,000 of rehab tax credits. But I have to reduce my LIHTC basis by the $800,000 in order to calculate how many LIHTC credits I can get. So the $4 million rehabilitation is reduced by the $800,000 of RTCs, which gives me $3.2 million times the 9% will get me $288,000 of maximum LIHTC award. And it's even worse if you're in a boost area, because you have to reduce before you boost. So in this area, so in, say, a qualified census tract or a difficult development area, I have to reduce my basis by the RTC, and then I multiply by the 1.3 basis boost. So It'd be so much better if it was reversed, but that's not the case. So one of the things I always encourage you to do, if you're looking at a project that could involve both LIHTC and rehab tax credits, is that for you to use the spreadsheet to do basically a simple test. You can turn the rehab tax credit on and off using this cell here. If you choose a 0, federal rehab tax credits are off. If you choose a 1, it's on. And so, and then you should toggle that on and off and look at your gap. I've seen lots of projects where seeking the federal historic tax credit actually costs me money because I reduce my LIHTC basis by more than what I'm gaining in terms of the rehab tax credits. And so it's very easy to just toggle this on and off and check to see, whether you're going to be better off. It is not a guarantee that you're going to be better off taking that RTC program. The other thing is that if it's really close, if you're only gaining a little bit, like $5,000 or $10,000, you really have to think about whether it's worth the added brain damage of going through 2 federal tax credit programs. I'm just trying to be real with you. With the historic rehab tax credit, your plans have to be approved by not only your local authority, but also your state historic preservation office and the National Park Service. So that's the requirements for your historic rehab tax credit. For your low-income housing tax credits, not only do you have to go through your locality, but NIFA is also going to do an architectural review. And so if you really want to try to get 4 government agencies to agree on architectural plans, go for it, but expect some pain in that process. So I would definitely encourage you, if it's financially worth it, go for it, but check to make sure that it's financially worth it. So there are some key deadlines with LIHTC projects, and one of them is a little. It's one of those rules that basically probably had a good intention when it was implemented, but is pretty impractical now. And that is this first one, which says that the project must be placed in service. So you have to complete the renovation and get it back occupiable by 12/31 in the year that your credits were awarded. So let's say I go through NIFA and I apply. They have a round that happens in February, and I get my credit award in April, and I have all my documents ready by May. I'm supposed to place the building in service by December 31st of that same year. Not likely to happen, right? Unless maybe you're doing a moderate rehab. But if you're doing a gut rehab, that's just not feasible. And so you really end up in a situation where you have to get a carryover allocation, which is what it's called. And so to get a carryover allocation, you have to incur 10% of the costs within 1 year of the credit reward. So what that basically says is maybe my award was in April, I've got 1 year to spend 10% of my money in order to keep that LIHTC allocation. So most projects end up getting carryover allocations. Now, if you do get the carryover, you have to get that building placed into service within 24 months of 12/31 of the year that you got the credit award. So I get the credit award in April. So 12/31. So let's say we'll talk about next year. So April of 2024, I get my credit award. I get my carryover allocation. I have to place my building in service by 12/31 of 2026. Right? So I have a little over 2.5 years to get the project done. Usually that's possible, but you know, I've seen things happen, COVID shutting down construction sites. I've seen cases where we had straight line winds knock down the building. We were, a third of the way through construction and we had a wind incident, put us back 6 months. Sometimes it can be a bit hairy. You're white knuckling it to try to get your project done. And you must meet the low income threshold in the year the credits are claimed. So not only do I have to place the building in service by 12/31 of 2026, but I really need to meet that income threshold. So if am I meeting the 20/50 rule or the 40/60 rule, I need to meet that. I have to have that occupancy as well. So I had mentioned the 4% program and the tax-exempt bonds. So there are some rules regarding that. Pretty much you have to spend at least, or you have to finance at least 50% of your costs with the tax-exempt bonds. And so you're getting an allocation of tax-exempt bonds from your state's volume cap for private activity bonds. So for this says 2021, but I actually think that these are 2023 numbers. Each state received $110 per resident of volume cap. Like I said, most states in the Midwest never use their full allocation of private activity bonds, and therefore the 4% credit is considered non-competitive. Some states are starting to approach competitiveness, so it's definitely something to talk with NIFA about, whether they're getting competitive for the 4% program or not. All right, so that is it for the LIHTC. Now, I also have some slides here on deal structuring. But before we get into deal structuring, let's just make sure that there are no questions regarding the credit program itself. And Angela, can folks unmute themselves if?
Yeah, feel free to unmute yourselves, or if you feel better dropping it in the chat, we can ask it for you.
All right. All right, well, hopefully LIHTC is clearer than mud, because I know that it's a tough, it's a tough program. So the next topic is, okay, so how do I, Corey, I've looked at my own tax situation, and I currently don't have enough passive income to use all the tax credits that I could possibly generate. And so, how can I structure a deal so that I get the full use of these tax credits? Well, you're going to go through a process called syndication. And syndication, I don't know if it's because it has sin in it or what, but it sounds sinister to me, syndication. But it's not. It's not sinister at all. It's basically just a form of group ownership. It's bringing partners into your deal. Some partners are going to be able to use tax credits, and you're bringing your expertise to the table, and they're bringing their ability to utilize tax credits and bring equity to the deal. So the art of syndication is to allocate the benefits in order to maximize the amount of cash that we can generate out of a deal. So most syndications are set up as a limited liability company or as a limited partnership. And there are some legal reasons for that. We want limited liability of our investor, right? Chase Bank does not want to put the billions of dollars that it has in assets at risk for your project in Omaha, or my project in Detroit or Cincinnati or wherever I'm working. And so they want to limit their liability, and the most that they want to put at risk is their investment. So they may be willing to invest, they may be willing to risk the $2 million of equity that they're putting into the deal, but they don't want to they don't want to risk the billions that they have in assets, because how else are they going to pay their CEO bonuses? Come on. Priorities, folks. So of the different types of entities that are out there, the only ones that both limit liability and provide a direct pass-through of benefits to owners are the limited partnership and the limited liability company. So let's talk a little bit about limited partnerships. And whether you set up a limited partnership or a limited liability company doesn't matter. I'm going to use the example of a limited partnership because I think that the terminology is a little easier to explain. So, I'm going to be using the words of limited partnership. So every limited partnership has at least, I'm sorry, I'm eventually going to use my document camera, but it's in my way. So every limited partnership has a general partner, which is usually the developer, and a limited partner, which is the investor. And so the general partner is the one running the project. They're providing their expertise. They are responsible for completing the development, for getting it leased up, and at least from the investor standpoint, their most important role is to generate those tax credits. And they typically own somewhere between a 0.1% ownership up to a 1% ownership. So they own a very small portion of the project. The investor, on the other hand, they're going to own the balance. So if it's a 1% on the general partner side, it would be a 99% ownership on the limited partner side. And the investor is supplying cash, basically. So in exchange for that cash, they're getting, though, a proportionate share of, based on their ownership, of cash flow, tax benefits, and appreciation. So let me try to do an example for you. And while that's pulling up, okay, here we go. All right, it's probably looking a little skewed. All right. So I think it's always best to look at this from, I'm more of a visual person. And so it's our project. Let me turn on the light. Hold on one second. I'm going to turn on the light in my. You know, when we started this at 3 Eastern time, it was pretty sunny outside, but it's now 4:50 Eastern time, and it's getting pretty dark outside. So, you know, so we have our project. So we're going to own our project under 123 Main Limited Partnership. And that limited partnership is made up of 2 partners. That's the simplest situation. We've got our developer, who is the general partner. And we've got our investor, who is our limited partner. And just to make things a little easier, I'm going to put the general partner at 1% ownership and the investor at a 99% ownership. You know, you can get more exotic. You know, you can do the 99.99%. But basically, in a syndication, what's happening here is that the investor is putting in equity, and the investor is getting out 99% of the cash flow from the deal. They're getting 99% of the tax benefits, and they get 99% of any net sale proceeds, so any appreciation of the deal.
Corey,
And yep,
is the investor and the developer ever the same person?
they can be, but that's fairly rare, because keep in mind that particularly for low-income housing tax credits, especially the 9% program, you're generating over 10 years, you're generating 90% of your construction costs in terms of tax credits. That's a lot of tax credits for an individual developer to be able to absorb. So is it possible? Yes. You know, I know Tamara, you know, it's been like 3 years since you were in class. And so you're probably what, 75% of the way of being that multi-billionaire. So, you know, maybe you're at that point. But you know, probably for some of the folks, it's maybe taking them a little longer. And so the developer is basically putting in their work, their expertise, right? They may be putting in land, you know, And what they would normally get out of the deal is that they would get 1% of the cash flow. They'd get 1% of the tax benefits. And they'd get 1% of appreciation. Oh, and they're also doing guarantees. They're also providing guarantees. And that's really important because they're really at risk, you know. So who is doing all the work? The developer. And who financially right now is getting all the reward? The investor. So there's an unequal split of work and reward. And therefore, as a compensation to the developer for all of their work, the developer is also going to generate a developer fee. And so the art of syndication is that the investor is mainly interested in this, right? They're mainly interested in those tax credits. And probably the developer is least interested in this because most developers just don't have that much passive income. And, you know, and so 1% of those tax benefits may be plenty for the developer. The developer is really interested in the cash flow, right? That's that month-to-month income that they're getting on the project. So one of the things that we try to do is we try to sop up money away from the investor towards the developer through fees. And so that could be deferring the developer fee, that could be a general partner loan, that could be a management fee, a partnership management fee, not success fee, but basically it's where if you keep the project fully leased for a certain amount of time, you know, some of these deals I've seen 20 different fees, you know. I'm going to charge the investor a fee for the sun coming up tomorrow, you know. I don't think the lawyer has come up with that one yet, but that's coming sometime, you know, sometime soon. And so all different types of fees to try to strip this away from the investor and towards the developer. And then
These all
appreciation is typically taken care of through an agreement, part of the agreement where the developer can buy out the investor basically for exit taxes.
This is all structured prior to
Yes.
project start, though, obviously.
Absolutely.
So, like, I've seen fees on construction projects where it's like acceleration fees to the builder or developer if they get it completed under 18
Sure.
months. If it's a projected, for every month they get another $250,000 quote unquote fee.
That's
That
right.
would go into that bucket going back.
Yeah. And
But that
so,
all
because
those have to be outlined.
Yes, they all should be outlined at the beginning. That's right. And that's where a good tax credit attorney is really vital, right? So the tax credits are actually generated on a monthly basis. So if I have 100, let's say I have 120 units, we'll make it easy on myself, and I'm renting 10 units a month, then I'm generating, you know, 1/12 of my total LIHTC each month. So I'm generating 1/10 in January, or I'm sorry, 1/12 in January, 1/12 of that annual total. And so if I can get my builder to complete the project 6 months earlier, I'm accelerating those units and I get the tax credits earlier. And that's real money. You know, that's a large amount of money on these projects. And so definitely, you know, definitely that's important. Yeah, we are basically at the end of the session. I can continue to wrap up, and anyone, you know, that would like to stay on, you know, please do so. If no one chooses to stay on, I won't talk to myself. I you know, hear myself speak too
Oh,
much
I'll
already.
be here, Corey. I
Oh,
did have
you'll
a
be here,
question.
Angela.
I always see this as a 99.99% and 0.00 or 0.01% partnership. Are there ever cases where it's a 50-50 partnership? Is that a thing? Or like on a smaller project where
So
they do
I
have
have
passive income?
seen, let's say that the developer has determined that the developer has looked at their long-term
Mhm.
taxes, because remember, you're getting these tax credits over the next 10 years.
Right.
So you really have to be planning ahead. But I've seen some cases where the developer has said, you know what? I would rather take the credits, and I think that I can generate, or I could use 10% of the credit.
100%, yeah.
And so this has been 10 and this has been 90, you know. But for the
Yeah.
most part, you know, that's pretty rare. Corporations can predict their taxes in the future a lot better than we can, you know.
Yeah.
And you know, and there's a reason why folks like Amazon are not in this market. If you never pay federal income tax, you never need to buy these, you know. So, you know, it's the vast majority of investors are banks, because not only do they get the financial reward here, they also get those CRA gold stars, right? That's, in some cases, that's more important than the financial reward. But I've also seen like Home Depot has invested in these programs. Sherwin-Williams Paints. You know, there are corporations that are related to construction that sometimes are investors as well. Tamara?
I have a question. What did you call it? The syndication rate where it was like 0.75 or 0.80. What factors determine that rate of
Sure.
syndication? What market factors and things affect that?
So interest rates, right? So things like well, the primary one is actually CRA. I've actually seen banks pay more than $1 per credit if they have a really strong CRA need in a census tract. You know, we had an investor, because NDC Grow America has a corporate equity fund, and we had an investor that had a desperate need for credits in a certain census tract in Chicago, and they basically told us, like, we will pay anything. You know, it's like, we will pay any reasonable amount if you bring us tax credits in this census tract, because, you know, we really, really need it. Those are rare, right? So typically investors will be seeking a certain internal rate of return, and they calculate how much cash flow they're going to be getting over the 15-year time period. They're going to be calculating the tax benefits they get over the 15-year time period, and then whatever they're going to get in terms of appreciation, which is typically just their exit taxes. So they're going to look at that, and And the market kind of depending on interest rates and other factors will kind of go up and down. So when internal rates of return are low, a few years ago, internal rates of return were about 5%, and tax credit prices were 95 cents on the dollar. Right now, internal rates of return are looking like their investors are demanding about 8%, and credit prices are down to, depending on some investors, you can get as high as like 88 cents on the dollar. Other investors are like around 85 cents on the dollar. So, each investor, they can't collude because that would be collusion and that'd be illegal. But, each investor has to determine how much they're looking for. But they do tend to have these trends. And so you can kind of get a sense of where the market is. Every year there's an affordable housing conference in Nebraska. And so, I strongly suggest if you're interested in this program to attend that, because, there'll be good sessions. You'll get to meet investors. You get to meet syndicators. So syndicators are basically brokers that match projects with their investors. And then, so they'll be at the housing conference, there'll be both direct investors. So some banks like to invest directly in projects. Some banks prefer to invest through a syndicator, through a third party. And there are advantages and disadvantages to both. So I think I've talked about this. And basically, you should consider syndication anytime where you're generating so much tax benefits that you as the developer won't be able to use them. And syndication is a good way of getting those tax benefits to someone that can use them, and they'll in exchange invest equity into your project. So you're raising the cash you need to do the project and kind of getting rid of something that may not be all that useful to you. So I think that I talked about that they're typically looking for an internal rate of return. Right now we're at the higher end of this internal rate of return. And so when investors want a higher internal rate of return, they typically offer lower price per credit. So I think that's it. In terms of, so I ran about 5 minutes over, but I can
that's
stay
not
on
bad,
for.
Corey.
I know that's a record for me. I'll talk about this. I'll talk about this subject forever.
Well, you put up the most important slide there. This is how
Yeah.
to get in touch with Grow America.
Yeah.
And I just wanted to say thank you, Corey, for coming back to us and sharing this information. As I dropped into the chat, Angel will be reaching out with a link to the recording, as well as another link to all of the materials that Corey provided for this class. I think
I'll put into the my contact information, my direct contact information as well. I never mind a quick call, or something if you run into a situation, and I may be able to provide some clarity, or at least point you in the right direction of a document or a professional locally that can help you.
Thank you, Corey. And thank you everyone for attending and supporting the Spark Developer Academy and our deep dive series. I hope you have a great night, no matter how dark it is out there in your specific time zone. And I hope that we can all see each other in person again soon. Take care, everyone.
All right. Take care.
Thanks, Corey.
You're welcome.